First of all, I'm very happy to be here. Thank you, Dr. Raja, for this presentation. I'm very glad to be here to present a very, very, very interesting hot topic. Okay, and I try to combine the energy transition effort, okay, with a very interesting topic, which is fiscal sustainability in GCC countries. Okay. So next slide, please. 10 minutes is not enough to discuss about this topic, so I try to summarize and to focus mainly on the most important ideas. Okay, next slide, please. So as we know, there are many very optimistic projections about the trend in terms of renewable energy. Okay, excellent. Thank you very much. So as you know, there is a very optimistic projections and outlook about the renewable energy production, and even a very, let's say, pessimistic trend about the global oil production. Okay, you know that there is two scenarios, the APS and the steps. So both expect that there is a high production in terms of renewable energy. Okay, in this context, all GCC countries, we know that all those countries depend on oil production. So in this context, oil production, GCC countries tried last decade to reduce their exposure to oil sector. Okay, and we have many indicators showing this, like, for example, the percentage of oil production to the overall oil GDP declined from 55% to 39%, the oil export from 75 to 61. Even there is some production from the International Renewable Energy Agency that the renewable energy generation in the GCC countries will increase. It will even exceed 25% in some countries. It will exceed 15% by 2035 in all GCC on average. So because of this, I had a very interesting question, and I want to try to find a good answer. So because of interest in energy transition, global and GCC, we have some impact on fiscal sustainability on GCC countries. So I will start with global. I call it external dynamics. So increase in energy transition in worldwide means higher renewable energy production, which may affect global oil demand. So this can affect GCC negatively by less oil revenue, by maybe higher fiscal deficit, and even maybe higher debt. But at the same time, we know that all GCC countries start to invest a lot in energy transition. So we start to see some diversification away from oil sector. This can boost non-oil sector. This can create more non-oil revenue for the GCC government. So less exposure to the oil sector. Maybe we'll have high diversification with all the benefits and the positive impact on GCC economies. So now we have two effects: positive effect coming from internal dynamics and negative effect coming from external dynamics. And my paper tried to answer a very important question, which is how could this trend, which is accelerating energy transition, affect sustainability in GCC countries? Okay, to do this, first of all, I try to, it's very difficult to define what is fiscal sustainability. In many countries, they have a very, positive primary balance, but at the same time, the fiscal sustainability, there is no fiscal sustainability. So that's why I use the fiscal reaction function, and I use the approach of Bone, which highlight two important conditions in order to have a fiscal sustainability in any countries. First of all, we should have a positive relationship between primary balance and debt. Means if a government issue debt, they should think about how they should think about primary balance. They should try to reduce their spending or to increase their revenues in order to sustain their primary balance. Second rule or second condition is we should have a negative relationship between primary balance and government spending, which we call in economic background, we call counter-cyclical fiscal policies. Okay, so in order to do this, I used to approach to understand how GCC government react to this energy transition effort. Okay, so I adjust the fiscal reaction adopted by bond in order to take into consideration some GCC characteristic. So I add, of course, trade openness, because GCC are very open economies. I add the oil prices, which is very important. Then I add the renewable energy, electricity generation, okay, in order to understand how this will impact, okay? So I will try to summarize quickly the result. I used two approach. First approach is comparing GCC fiscal sustainability with other similar and not similar countries. So I choose OPEC, okay, it's very similar to GCC, NOEC, which is non-oil, net oil exporting countries. Then I add two group of countries which are completely different than GCC. G7, well-diversified countries, and top 10 energy transition in terms of investment. Okay, just to compare how fiscal sustainability in GCC with other countries. Okay, quickly the results show that all countries are sustainable in the short term. I use RDL in order to highlight two sides, short term and long term. So short term show that all group of countries are sustainable in the short run. GDP highly positive with the primary balance. Government spending is positive in oil dependent countries, which highlights the pro-cyclicality of the fiscal policy, but it's negative in other G7 and energy transition investment countries. Trade openness, for sure, it's negative for the oil countries because depend a little bit, depend more on oil price fluctuation. And for sure, oil price is positive, has positive effect on oil exporting countries and negative effect on advanced countries. We found the same result in the long term, but with higher coefficient, which highlight more the long-term effect. Now I do the same for oil price, but I change the oil price with oil volatility. What I want to highlight in this slide, that oil price affect positively the GCC countries and negatively G7, but the oil volatility affects both negatively. Why? Because the high volatility give more freedom to the government to decide about their spending. So that's why I want to highlight that oil volatility is even more important than the oil price level. Okay. Now we understand that well-diversified countries that focus more on energy transition, are have less exposure to oil fluctuation. But what I want to highlight now, I add in the same fiscal reaction function, I add the global energy renewable generation. And what I found, once I add it in the equation, the debt is still positive in the short run. But when I add it in the long run, the relation become negative. What this mean exactly? So in the long run, higher global energy transition will affect negatively the fiscal sustainability of all countries depending on oil, GCC and OPEC and all net oil exporting countries. Okay, so now this is the negative side in the long run. There is no impact on the short run, but there is a negative impact on the long run. But we know that all GCC countries invest a lot in energy transition. So I replace the global energy renewable with a national renewable energy, okay? Just to see if the investment made by GCC countries will attenuate or will reduce or no the negative impact of global. So once I add it in the short run, okay, this is a positive correlation, which is good. The debt is still positive, so it's still sustainable in the short run. Now in the long run, which is very interesting, the debt is not negative anymore. Okay, so if GCC countries continue to increase their investment in energy transition in domestic level, this will attenuate the negative effect of global energy transition. Okay, and it's really clear. It's clear that the coefficient is very small in the short run, but become even higher in the long term. Okay, now I try to summarize what I present. So fiscal deficit in the short run, it's not an issue for GCC countries. Okay, the key challenge, the main challenge is the long run. We still have debt level is still very low. Still, debt level is very low. We still have high margin to invest in many other sector, to invest in economic diversification. But the main challenge is the long term. So any increase in the global production of renewable energy source may lead to a decline in global demand for oil sector. This is clear. We know that it will happen. But we don't know why. Maybe 2035, maybe 2050, maybe 21. We don't know yet. But what we know that if GCC countries keep investing in energy transition in domestic level, this could attenuate the negative effect of global energy transition. Okay, so my conclusion or my policy recommendation in the short run and medium run, I think it's better for the GCC countries to continue investing in oil and gas sector, okay, in order to benefit as maximum as they can from oil production, given the high uncertainty in the market. But in parallel, they should invest a lot in economic diversification and mainly in a development of low carbon energy sources, which is very, very important for the GCC and all oil producing countries. And thank you very much. I hope that I respect the time.
Thank you so much. Thanks a lot. You've been able to manage presenting this complex issue within the limited time. So thanks, Asil. Now, the second paper will be about economic diversification and global spillovers from U.S. monetary policy, implications for GCC economies by Bedri Camille Honortas. Sorry.
Yes, okay.
Hi, so you have 15 minutes.
Yes, sure. Okay. So thanks a lot for attending. And this is a joint work with Ozan Ekşi from TOB University. And in this paper, what we are trying to do is we are trying to understand why economic diversification is desired for economies, and we are trying to provide an additional motivation with respect to vulnerabilities of these economies to outside shocks. And in this case, we are focusing on spillovers by US monetary policy. So there are a lot of course, technical details with respect to the empirical methodologies. I will not be talking about these, but basically we have these initiatives for GCC countries and also for other countries to decrease the reliance on hydrocarbon revenues and increase economic diversification. So in this case, we are trying to understand whether there is a relationship between resiliency of these economies to outside shocks, especially international financial shocks with respect to economic diversification, and we are trying to establish this relationship empirically in this case. So basically, we are focusing on US monetary policy spillovers, and in the literature, also we discuss about the literature in the paper, but I don't have it in the slides. But what we have is, so whether that matters for the other economies, and in the literature this is an established fact. So we know that there is a spillover effect of US monetary policy, and here we have the shadow federal funds rate, because after 2008 it reached zero lower bound, but with unconventional monetary policy actions the expansion continued, and the shadow rate can be negative in this case, representing, even though there's the zero lower bound, still United States is conducting expansionary monetary policy. So how does this affect other countries? So first, what we do is we identify US monetary policy shocks, and here what we have is whether this will have an important effect on other countries or not. So first, how do we measure economic diversification? So we follow the paper by the for the World Bank. They use two different measures, so we have both of them. But with respect to the results, I will be only showing the ratio of manufacturing and manufacturing plus service to per capita GDP. So with respect, again, what we do is we depending on data limitations, we obtain the data from the IMF and the World Bank World Development Indicators, and we see that with respect to ratio of or percentage of manufacturing to total GDP, we have a quite a variation with respect to countries. So let's what kind of an effect this have on all of the countries and also with respect to GCC. And I have the diversification measure calculated using the World Bank data in this case. And here I also the manufacturing percentage, I am just presenting for year 2019, but with respect to our analysis, we have a panel data, so we have the time variation. And in some cases, average growth of manufacturing has also been used in these cases. So let me continue. And first, what we do is we conduct a global VAR analysis, and this is desirable because it also considers the trade links between these countries. And of course, there are some data limitations, but we use Danton's interpolation method to convert annual data into quarterly frequency. And in the end, if we consider all the countries that has been analyzed, we see the negative effect. So this has been established, but the studies end at 2016. So we extend these studies and we see that, yes, on average, there's a negative effect of US monetary policy shocks on GDP of all of the countries in the world. So, and we also see that with respect to GCC countries. So, but here what we have is we have 20 quarterly impulse responses, and I'm just representing the average of these. And we see that there is a negative effect also on GCC countries. So, because of data limitations, we can only analyze 4 GCC countries here. And also, and after the global VAR analysis, we also wanted to see whether there's a time variation in these shocks. So we conducted time varying coefficient analysis, and using a Bayesian estimation method, we calculated time varying coefficients. So with respect to time, we haven't captured a lot of variation, but still that's significant. So we have the confidence intervals, and we have a significant negative effect of US monetary policy shocks on GCC economies. So we see that for Bahrain, Oman, Qatar, and also Saudi Arabia. So, but after 2020, for example, the confidence interval is getting wider for Saudi Arabia. So Saudi Arabia is becoming more resilient, but of course, more studies need to be conducted related to this. So now we have established with respect to all of the countries in the world, there's a negative effect of US monetary policy spillovers, and also GCC countries are affected when the Fed increases the interest rate. So now what we would like to understand whether economic diversification plays a role in that sense. So what we do is we estimate a smooth varying coefficient model in the sense that we would like to analyze whether these coefficients of US monetary policy shocks on GDP of all of these countries change with respect to different levels of economic diversification. So in this case, this is our main result. And here also we have in the paper, we have the results with respect to manufacturing plus services. So what we see is when the ratio of manufacturing as a measure of diversification increases, then the coefficient is becoming smaller, and also at the highest levels, it becomes insignificant. So we can just say that there is the positive impact of economic diversification in the sense that these economies are becoming more resilient to US monetary policy spillovers. And also in this table from the paper, we can also see the results also represented in the figure. As we are mostly interested in the first row, which is the US shock that we have calculated using the shadow rate. And at the 10th percentile, meaning that this is the countries with lowest levels of economic diversification, we have a high coefficient, and that's significant. And when we move to the other tail, to the end of the economic diversification, what we see is the coefficient is getting smaller, and at the end, meaning that with very high levels of economic diversification, it becomes insignificant. So basically, this constitutes our main results, the figure and the table. What we have established is using more recent data. Yes, US monetary policy has spillover effects, and what we see is economic diversification has this additional effect with respect to resilience of countries, all of the countries, including GCC economies, that they will become more, the vulnerability of these countries will be decreasing in terms of US monetary policy spillovers. So finally, so what we have seen is countries with higher economic diversification become more resilient to US monetary policy shocks. So this is what we established empirically in this paper. Okay, I hope I managed to present in 10 minutes, or I haven't rushed too much. Okay.
Thank you so much, Badri. Thank you for respecting the time. Now we, by the way, at the end of all papers, we will have time for questions. So if you have any questions regarding any of these papers, please write it down, and let's, after the end of the paper, we'll give the floor for any of your questions to be answered by respected panelists. The third paper will be the role of energy transitions and economic structures and import demand for petrochemicals by Fakhri Hassanov and Samar Mohammed and Ivar Omizor. Fakhri?
Good morning, everyone, and thank you for joining this presentation. This is a joint work with Samar Mohammed and Ivar Omizor, my KAPSARC colleague who is sitting back there. So basically, what we were trying to investigate in this paper was to see how much renewable energy transition and industrialization in developing economies can change the common sense view, which is about energy transition, can bring a lot of challenges for hydrocarbon economies, especially oil exporting countries. There are reports by EIA, IEA, and the other energy entities established internationally that the main demand for hydrocarbons will come from feedstock for petrochemicals in coming 2 decades. So this is what they project. And as I said, there is also literature that talks about this is not only the challenge, but also opportunity for oil exporters. So what we were trying to do to get motivated by these 2 facts and to see whether we can prove or disprove this one empirically. So all it said is just reports and some descriptive analysis. So this was the main motivation of the paper. And as I said, we looked at the impact of renewable energy transition and economic structure measured by industrialization on petrochemical imports in developing countries. So in other words, the import demand of developing countries for petrochemical products. So we just take standard demand function and expanded it with renewable energy transition and economic structure. You can think of it like a theory-driven approach combined with empirical approach that was advocated by seminal scholars like David Henry, Juselis, Johansen, and others. So this is the empirical specification that we will estimate econometrically. So the left-hand side one is import demand of the developing economies for petrochemical products, which is the function of Y, which is their income, and price ratio of domestic versus international, which is PR, and renewable energy measured by installed capacity of solar and wind in these developing countries. And lastly, this is ES denoted for economic structure. So this is measured by industrialization, the value added of industry in total GDP. Yeah? So it's actually here. So this is the data, describes the definition, measurement, and source where we have collected. So we are doing panel time series analysis. I have to highlight it. It's not panel per se. It's not time series per se. So we have collected data from 1996 till 2022, and we have 10 top developing countries in terms of renewable manufacturing. So it starts with China, ends with Czech Republic. So we, in a nutshell, we have 10 countries, and the time series spans from 1996 to 2022. So this slide just illustrates two key indicators, which is our main variables of interest. Petrochemical imports of these developing economies and renewable energy installed capacity in these developing countries over time and in the selected 10 countries. So as a research strategy, we used, as I said, panel time series analysis, and therefore we have to take care of many things, like is there cross-sectional dependency, is there slope heterogeneity, is data stationary or non-stationary over time, and etc. So all of them are illustrated in this chart. And we ended up using second generation panel techniques. That's completely different from the first generation in a sense that it doesn't only give pooled commonalities, but also country-specific features in terms of regression analysis. So I'm not going to bother you with econometric technicality, but let me briefly mention that we found cross-sectional dependency across all these countries, all these 10 countries. So they are also non-stationary in terms of their data that we consider in our analysis. But the good news is that this non-stationary data is integrated. So we have a chance to find long-run relationship. So we have estimated basically 5 different specifications, depending on which variables are entering or excluding from the specification. The last one we preliminarily focused on is the model 5, which shows a positive effect of installed renewable capacity on import demand for petrochemicals in these developing economies. And also we found the same for economic structure. So they are pretty much expected. But again, what we did, we showed whether it is backed by econometric analysis and what's the magnitude, and this magnitude is significant or not. So that's our main merit of our study. So this is country pooled estimation results. As I said, this is all countries all together. For example, 1% increase in renewable installed capacity leads to 0.1% increase in the pool of these countries. So it means that these countries are in common in this estimated elasticity. However, it's not so interesting for policymakers because how can I suggest something Chinese policymaker, which is the same with Czech Republic policymakers, right? So that's why we also delve into country-specific characteristics and see how this relation changes from country to country. And we see actually big variation. For example, the size of elasticity is quite diverse when it comes to renewable energy installed capacity elasticity of petrochemical imports. So it varies from 0.004 in Romania to 0.4 in India. And the same thing is true for economic structure. So in Brazil, the elasticity is nearly unity, but in India, it's 5. So it again highlights the necessity of not only looking at the pooled commonalities, but also country characteristics, although we are doing panel time series analysis. And that shows how diverse in terms of impact coming from renewable installed capacity on petrochemical imports of those countries. So what we would conclude with would be that, yes, the energy transition is not so bad thing. It really creates opportunities for petrochemicals, and through petrochemicals for hydrocarbon, because all these feedstock are coming from oil refinery products. And second, yeah, industrialization in some developing economies lead to more demand for petrochemicals when it comes to specific industries like automobiles, electric cars, healthcare, and etc. So we don't have policy recommendation, but we have policy insight, which says that petrochemical exporting countries like Saudi Arabia also should or may want to consider this opportunity. So the growing demand in the international market coming from renewable installed capacity. Thank you very much.
Thank you, Fakhri.
Sure.
Now with the fourth paper will be about energy transitions in oil-dependent economies, public discount rates for investment project evaluation by Fatih Karanfi and Axel, please.
Okay, good afternoon. So today I will present you a paper co-written with Axel Pierrot, who is unfortunately not here this afternoon. So the paper is recently accepted for publication in the Energy Journal with the same title, about energy transition in oil-dependent economies. And in this paper, we are looking at the public discount rates for investment projects evaluation. With Axel, we started thinking about public policy making in oil-dependent countries a couple of years ago. And the first work we published in the journal Energy Economics was about the opportunity cost of oil. And in that paper, we challenged the idea that any commodity which is subject to international trade should be valued by its border price. And we showed this in this paper that for an oil exporting country, the opportunity cost of oil or the shadow price of oil can be significantly lower than the international price. When we were looking at this issue, so there is one equation we used in that paper, and what we see here is there is 1 over 1 plus d, which is the discount rate. So we realized that the discount rate that we are using in public policy making is an important input. But at that time, we didn't focus on the value of discount rate, and we took some numbers from the literature. So the motivation in this paper is that as Dr. Majid was talking about this morning about the energy transition related public investment projects, we are asking what discount rate should we use in those projects. We know that most oil exporting economies are trying to diversify their economies by trying to increase their efforts in industrial development, and another objective also is to decrease their dependence on oil revenues. To give some numbers, we see here, for instance, for the case of Saudi Arabia, we have more than 3/4 of the government revenues which are coming from oil. In this situation, in order to select welfare enhancing projects, we need to understand the extent to which economic dependence on oil can impact the present value of oil-related cash flows that can come from public investment projects. And for this, there is a need for public discount rates that can capture the risk of the cash flow and the characteristics of any oil exporting economy. So we have a quite simple welfare maximization problem in this paper. We are considering that we are investing today in a public investment project, and this investment project will free some fixed quantity of barrels of oil from domestic consumption, and we will be able to export this oil into the international market. Okay, instead of using the international price, which is PT, we are saying that we will consider the opportunity cost of oil. Okay, as I mentioned, we showed in our previous paper that the opportunity cost is actually lower than the international price. And this opportunity cost depends on different factors, such as the price elasticity of global oil demand or the share of the country in the global oil market. So the net present value of this project is given by the equation below. And if the future cash flows, which is given by the sum of the every quantity of oil we are exporting, valued at the opportunity cost, is higher than the investment cost that we are facing today. So if we assume that a utility function, if we assume we have a utility function given by the equation we see here, which is increasing and concave with respect to consumption. When I say consumption, it is the gross consumption. I'm not talking about the oil consumption. It is domestic per capita consumption. We can define a risk-free discount rate, which is RF here, and it has two main components. One of them is the wealth effect. Wealth effect is the average per capita aggregate consumption growth rate. And on the right-hand side, we have the precautionary effect, which is given mostly by sigma square, which is the volatility of the growth rate of per capita consumption. What we see here is that if the growth rate of per capita consumption is high, then we will have a stronger wealth effect. And if we have more volatility, we will have more uncertainty in the economy, and we will have a bigger precautionary effect, resulting in a higher, resulting in a lower risk-free discount rate. So this risk-free discount rate should be applied to cash flows that are not related, that are not correlated with consumption. Why I'm saying this? Because if your investment project has cash flows which are correlated with your economy, which is the case here, then in that case, you need to use a risk-adjusted discount rate. What you are doing is just you are adding a risk premium to your risk-free discount rate, and the risk premium is given by the covariance between what you are getting from your investment and the per capita consumption you have, which means that if your project is correlated, or if your covariance is positive between prices and the consumption per capita, this means basically that your investment is introducing some risk, some macroeconomic risk into your economy. So you need to take into account this risk premium. And in that case, if your project is related to oil, if it is touching your domestic oil consumption, then you need to use this risk-adjusted discount rate. So what connection can we make between the discount rates and the economic dependence? As the previous equation was showing, the oil price fluctuations make the economy more volatile. And if you have more volatility, you have more uncertainty about future consumption level. And this will have a precautionary effect in your risk-free discount rate. And as I showed you in my previous slide, this will lower the discount rate that you need to use. But on the other hand, if you are highly dependent on your oil exports, then you have a high correlation between oil-related cash flows and the aggregate consumption. In that case, this will introduce more high risk premium to your project. And again, in my previous slide, this will at the end lower the present value of future cash flows. So there are two opposite impacts of economic dependence on oil on the public discount rates to be used. So the question is, which effect holds greater significance? And what is the magnitude of the oil price risk premium? And do the effects vary significantly between different countries? So we did this exercise for 18 countries, but let's have a look at the GCC countries. We have here the growth rate of per capita gross consumption in 6 countries, 6 GCC countries. What we see here is that the growth rate is highly volatile, and the average standard deviation is 0.08, which is 6 times higher than OECD countries and the USA, because we looked at those countries during the same period, and we see that they have very less volatility than the GCC countries. Another issue that we observed when we were looking at the data about GCC countries, and last week we were chatting with Dr. Majid. He also raised the same issue. Usually, what we can expect from our intuitions or from the economic theory is that economic growth normally brings higher per capita consumption. But this is not happening every time for the GCC countries. Why? Because when there's economic boom, the countries are receiving more expatriate workers. So the population is increasing. As we can see here, for the case of UAE, we see that the total population increased exponentially, very high after 2005. But when we calculate only Emirati citizens in the country, we have a smooth increase in the population, which means that if you use total population rather than only citizens, you will end up with having a negative per capita consumption. So in order to mitigate this potential bias for the GCC countries, in our analysis, we used only the citizens of the countries rather than using the total population. So here are the results. So we see here in blue, I highlighted the GCC countries. We see here on the left-hand side risk-free discount rates, and on the right-hand side risk-adjusted discount rates. So risk-free discount rates again should be used in the projects which are not correlated with the aggregate consumption. And risk-adjusted discount rates should be used for the projects which are related to oil consumption. What we are seeing is that there are significant disparities in country-specific discount rates, which is emphasizing that we need to be careful when we are choosing the public discount rates. For the average GCC discount rates, we see that the risk-free discount rate is 2.4, which is smaller than our panel, but then risk-adjusted discount rate is 5.2, because we have a very high risk premium, which is 2.8, which is normal because the per capita consumption in those countries are highly correlated with the oil prices. Okay, so in any project which is touching the domestic oil demand, in those GCC countries, we can use a risk-adjusted discount rate on average of 5.2%. We made some additional analysis to see whether there are any correlations between different discount rates and other macroeconomic variables. We saw, for instance, that for countries which are less diversified with respect to their exports, they are highly vulnerable to oil price fluctuations. By the way, so when we increase the export diversification index, we are actually decreasing the export diversification. So we need to read this figure in a way that countries who are on the right bottom side of the figure, they are mostly countries with higher export concentration. All right, so we also try to show how our results can materially impact the public evaluation of future cash flows. So the exercise that we are doing is that as I showed in my previous slides, imagine that we have a project which is freeing 1 barrel of oil per day from domestic consumption, and we are exporting it into the international market. Every day, 1 barrel of oil. And we are discounting the future cash flows of this one additional barrel of oil exported into the international market up until 2040, using the international prices that are coming from the IEA's stated policies scenario. And we are looking into different components here: the opportunity cost, risk premium, risk-free discount rate, and present value. So we are decomposing the impact of all those factors which are playing a role in the evaluation of future cash flows. What we see here is that on average, opportunity cost decreasing the value of cash flows by 6%, but on average for GCC countries, we have a huge reduction. When we consider all those things, we have a 50% of reduction, but those numbers are quite different within each country. Qatar is suffering the most because they have a huge risk premium. Saudi Arabia has a huge opportunity cost because they have a huge share in the global market. So my last slide is why it matters. As I mentioned, you are a policymaker, you want to invest in energy-related projects, and you need to have a discount rate, an appropriate discount rate to value your future cash flows. And this is especially critical for oil exporting countries who are pursuing currently domestic energy transitions and industrial developments. Thank you. Thank you very much.
Thank you, Fatih. The last but not least, paper titled Fiscal Policy and Macroeconomic Stability in Oil Exporting Countries, Evidence from Saudi Arabia, by Maiz bin Tahir, Rajal Marzougi, Sarah bin Suleiman.
Thank you, Dr. Raja. Good morning, everyone. The title of the paper that we'll present today is the Fiscal Policies and Macroeconomic Stability in Oil Exporting Countries, Evidence for Saudi Arabia. So we think that this topic is very relevant as actually we know that oil exporting countries are facing major fiscal policy challenges. This major policy challenges come from the fact that oil exporting countries are highly dependent on oil revenue and largely exposed to external risks, mainly a large fluctuation in oil prices. So we can say that the main fiscal challenges are related to the issue that fiscal our revenue are exhaustible, volatile, uncertain, and largely originate from abroad. So the exhaustibility, as you know, raises the issue of sustainability in the long run, and also the uncertainty and volatility complicate the macroeconomic management and the fiscal planning in the short term. Another important point is that given the high response of fiscal policy to oil price shocks in these countries, we consider that the role played by the fiscal policy in these countries as a main source of macroeconomic stability or instability is very relevant for these countries. So to tackle or to resolve this issue, in general, the traditional advice for these countries is to develop a counter-cyclical fiscal policy. It means governments in these countries are invited to build buffers in good times and use these buffers during bad times in order to stabilize the economy. It is very important to highlight that this task is not easy to do, and it constitutes a more complex and critical challenge for oil exporting countries for two main reasons. The first one is that in these countries, the business cycle is generally closely related or linked to the unpredictable oil price fluctuations. And the second one is that the procyclical fiscal policy, which are the main rules in these countries, tend to amplify the already volatile business cycles. So by transmitting the oil price shocks to the domestic economy. So for example, causing overheating economies when oil price rises and causing recession when oil price drop. Also, regarding the empirical literature, we have found three main facts. The first one, we can say that there is a wealth of studies on fiscal cyclicality for developing economies and emerging markets. And the main results coming from all these studies, we can say that fiscal policies are procyclical for business cycle and also regarding to commodity price cycles. However, we observe that there is a handful of paper for oil exporting countries. There is less studies tackling this issue for oil exporting countries. And from the existing studies, the main results is that also these countries suffer from the issue of procyclicality of fiscal policy. Now, when we come to the case of Saudi Arabia, unfortunately, we didn't find relevant studies. We have only two studies with conflicting results. The first study provides some evidence regarding the procyclicality of fiscal policy with the oil price cycle, and the other study, in the contrast, provides some evidence about countercyclicality with the business cycle. This is the first point. The second one, the second point is we know little about how procyclicality react over oil price, over oil cycles. We can cite the recent study, a paper of Duran, Lisserve, and Karanfil, 2023. This paper is very important because it gives strong and robust evidence about the asymmetric response of fiscal policy regarding oil and gas revenue cycles. And the third point is there is no the third point is that we observe that the potential effect of procyclicality, now not fiscal policy, the procyclicality on macroeconomic performance are largely ignored in the literature. Basically, there are two small groups of studies. Some of them are focusing on volatility effects, and the other group is focusing on the procyclicality effects. And finally, the common result that the procyclicality has a side effect on macroeconomic performance. Regarding all of these elements, we fix two main objectives for this paper. The first one is we need to qualify the cyclicality of fiscal policy in Saudi Arabia, but from a symmetric framework analysis. It means that we need to test whether fiscal policy response to positive and negative oil price shocks are asymmetrics. And I think the originality of the main contribution of this paper is we try to use a new approach to estimate the macroeconomic effects of fiscal procyclicality. So to attain this objective, we will develop an empirical methodology going through 3 steps. The first step is we need to qualify the stance of the fiscal policy, meaning is the fiscal policy in Saudi Arabia is basically procyclical or countercyclical, but regarding now the oil price, the oil price. The second step, we need to qualify the asymmetric fiscal cyclicality over oil cycles, and the third one is related to the macroeconomic effect of procyclicality of fiscal policy in Saudi Arabia. So regarding the step number 1, the objective of this step is to qualify the cyclicality of fiscal policy. For that, we will estimate a fiscal reaction function where we regress the government spending on the oil price, and also we regress separately the current spending and capital spending with the oil price over the period 1980 to 2020 using the ERDL model. This model allows us to separate the long run and the short run effects, and also to resolve the issue of endogeneities. This table provide the main results of this estimation, but the most important result that we can observe in this table, there is a positive relationship between oil price and government spending. This means that fiscal policy is procyclical in Saudi Arabia. And the second important result is that this procyclicality is more pronounced for capital spending. It means that capital spending, capital expenditure is not used by the government as a tool to stabilize the business cycle. Now let's move to the step number 2. This step, the objective of this step is to test the hypothesis that the government can adjust, the government have different fiscal policy adjustment regarding whether the oil price shocks is positive or negative. So for that, we decompose the oil price into components. One of them is the positive shocks, and the second one is negative shocks. We will estimate the same fiscal reaction function with asymmetries, and using now the nonlinear ERDL model. The most important results from this estimation that we have, that we can say that oil price shocks, positive and negative oil price shocks, have opposite effects. It means that we can say that oil price, the fiscal policy response is asymmetric regarding whether the oil price is positive and negative. So we can say that during when the oil price increase, the government continue to maintain a procyclical fiscal policy. And when the oil price decrease, now the government run countercyclical. I think we have there are two main reasons for this last results. The first one is that during bad times, let's say bad times, the government are less prone to take socially costly adjustment measures. And the second one, the government can increase expenditure during bad times using the buffers that are accumulated during previous periods. This is what we can say about this second step, and this will definitely give evidence that there is a symmetric fiscal cyclicality over oil price cycle for Saudi Arabia. Now let's move to the third step, which is the most important part of this paper. In this paper, in our mind, we try to give a feasible approach to quantify the macroeconomic effect of procyclical fiscal policy. For that, we will refer to Marioli and Weg, the recent paper of Marioli and Weg, to measure the amplification effect of procyclical fiscal policy. So their paper, this paper is based on the expression when it rains, it pours. What does it mean? This expression is very, it means that the procyclical fiscal policy will amplify any effect for any change in oil price. So for example, a fall in oil price provoke an first wave, let's say an initial recession, which is the direct effect coming from oil price to the output. This is the rain component. Then when the government responds with the procyclical fiscal policy, this will exacerbate or amplify the business cycle, and this is what we can say the pours components. So finally, the overall change in GDP, for example, it's the sum of the rain and pours. The rain is the direct effect, and the pours is the amplification effect. So following Marioli and Weg, they used four-stage methodology. The first one, they quantify the total output effect. It means they estimate the effect of all price changes on outputs. The second one is that they estimate the fiscal reaction function, which already done for our case. The third stage, they estimate the average fiscal multiplier. And the last stage, they calculate the pours component. Finally, the pours component is, we can calculate the pours component using this equation. It's the change in oil price. We multiply by the coefficient of procyclicality that we have estimated in the fiscal reaction. We multiply by the fiscal multiplier that we can consider as the main channel of transmission between government spending and output, and finally we multiply by the ratio of government spending to total GDP. For the first stage, we have regressed, we have estimated an equation where we regress the output on oil prices. Here we consider the output as the non-oil GDP to avoid any issue of indigeneity between total GDP and oil prices. And also we included two control variables, which are the money supply and government spending, to control the main channel of transmission between oil prices and the output. The period is the same, and also we used the model, the ARDL model. Quickly, the main results here. We observe that there is a positive relationship between oil price and output. It means there is a procyclicality between the business cycle and the change in oil prices. As we say, stage 2 is already done. Stage 2 is already done. The third stage, here we estimate the fiscal multiplier for Saudi Arabia. For this, we used this data, non-oil GDP, government spending, and government revenue, and also we estimate separately fiscal multiplier for current spending and capital spending. We used the local projection method of Jordan because this method gives us more flexibility and less parameter for the impulse response functions. This table provide values about. Okay, this table provides values about fiscal multiplier. The main results is that the fiscal multiplier in Saudi Arabia is relatively small. Stage 4, for the first table, show the pours component as a percentage in non-oil GDP. Just for instance, for the ports component, the value 16.9%. It means that when the Saudi economy faced, for example, a drop in oil prices, 16.9% of total drop on GDP is explained by the procyclical response of the government spending. Also, this value range between 11 and 8% for current and investment spending. Finally, as policy application, it is very important to consider the asymmetric effect of oil prices. Maybe the policymakers are invited to tackle the issue of procyclicality during good times. There is a need to establish a policy framework to help the economy to cope with uncertainty and volatility, and also fiscal rules is timely warranted to avoid any discretionary fiscal policy. Thank you, Dr. Rajab.
Thank you, Maaz. Now we have about 15 minutes to 20 minutes for questions. Dr. Amar.
Thank you. I have a question or a remark very briefly for you on this paper, and then a question for Fakhri. So in addition to the quantitative evidence you present, there's some very straightforward qualitative evidence you could present, which is that if you were to look at government statements, when the government says we're going to do some increased spending in terms of doing a fiscal stimulus, that happens sometimes when oil prices are higher and sometimes when oil prices are lower. Whereas when the government says we're going to do austerity takhashuf, I don't think I can think of any example of takhashuf happening, austerity happening when oil prices increased, which is what's supposed to happen under counter-cyclical policy. So even if you don't look at any quantitative data, just by looking at the qualitative data on mentioning austerity versus mentioning stimulus, that alone indicates the pro-cyclicality and some of the asymmetry that you mentioned, which is that you see stimulus coming sometimes when oil prices are higher and sometimes when oil prices are lower because they're trying to keep things going. And even actually there with the qualitative evidence, I bet if you looked at the statements, you could infer the current versus capital spending distinction again, even, and then so all of that, what I'm saying is it further reinforces what you're finding quantitative, I would imagine. I haven't looked at it, but if you could maybe, I don't know what stage the paper is in, but you may want to consider adding a page just on the qualitative evidence that matching the quantitative. And then for Fakhri, when you put the data up for the different countries, it looked like, so all of them had installed capacity increasing. Yeah. And then they had petrochemicals demand increasing, but then the last 5 years, it looked like all of them were So how did you end up with and demand for petrochemicals being increasing in installed capacity when it looked nominally as if total demand for petrochemicals was decreasing? I don't know if it's possible to bring the presentation up so I can see the graphs.
Yeah, that would be better.
So we can have another questions while they prepare it. Otherwise. Asid. Mike.
Now it's better. Yeah, sorry. My name is Fawaz. I'm a freelancer, so I could that give me latitude. I was surprised, frankly, by your conclusion on minimizing, if you will, the risk of fiscal deficit and leverage, because my impression is we have a growing operating leverage, if you define operating leverage as increasing expenditures, running expenditures, and investment in buildings that don't generate actually a return. So if you take that with increasing, steady increasing fiscal deficit and operating leverage, and the uncertainties around oil revenue. I'm not going to say the price or and increasing interest rates. It seems to me the threshold for maybe because I come from financial background, increasing the threshold for to be conservative must be higher in these countries, because simply your policies could go wrong. So I was surprised you minimized the risk. It seems to me the policy implication would be actually to reduce leverage and reduce it significantly, frankly. And my second question, if you will,
very quick.
Quick, yeah, I will be quick this time. I was thinking of the cost of capital, if you will. And in the context of the GCC countries, because they are highly internationalized, one would think it is a function of two buckets, if you will. One bucket is the G20 or G7, and the other bucket is local as much as we can. And just to mix them, and as per the level of diversification in the economy, and come up with a cost of capital for these countries. Is that conceptually correct? I mean, is that counter to the model you presented?
Okay,
thank you.
Thank you. Want to answer?
Yeah, of course.
Try to be short in your answer, so you'll have more questions.
Okay.
No problem.
So thank you for the questions. So what you are referring to is the last couple of years, right?
Yeah, I mean, some of them are.
Yeah, but if you look at the entire sample where we did regression analysis, it's 23 years. Let's say 23 minus 3. So 20 years gives me a positive relation because both of them are upward trending.
Most of them, it's like only 10 years of growth because the renewable energy was more or less zero until like 2006.
Yeah, but the overall the trend is upwarding, right? Both of them, and we actually didn't put there, but in the paper we have scattergram between the two, which shows again the positive relation, what we have found from the economy.
Thanks, Fakhri. Asil?
Affect oil revenue for GCC countries. Okay, so we know that GCC countries started during this decade to invest a lot in economic diversification and even in parallel in energy transition. So what I show in the paper, so if the GCC continue in this, and this Saudi, for example, we have oil. So in theory, we don't need solar energy. But we are investing this, we are preparing for the future. So if we keep increasing our investment in energy transition, even if, as Dr. Majid said this morning, that it will help us, to have a backup or to have even a future sector that can help us effect from this global transition. I know that in operation side and from financial side, it's difficult. I just presented 2 weeks ago another paper about how economic diversification and how the lot of money and billions that we are investing could affect fiscal sustainability. But that's why I use in this paper RDI model to show that there is no big or limited impact in the short run, but in the long run you have a negative effect. That's why continuing investing in energy transition will reduce the impact. Frankly, I don't believe in this completely energy transitions. The fact that we will go from 100 million barrels per day to 80 or to 50 in coming years, but this will give us time or a margin to try to prepare for the future.
Thanks, Asil.
Yes. Okay. Thank you very much for this question. So the public discount rates that we are calculating and offering are for the cost benefit analysis, and what we are showing is the benefit side, and of course the cost side needs to be also taken into account. But in any case, if the net present value of the future cash flows coming from your investment is higher than the current capital cost of you have, then your investment is profitable. But we are not looking into the cost side of it. Thank you.
Thank you. Any questions?
Thank you very much for the presentations. So let me ask question to Bedri and also Fatih. So what kind of Bedri was talking about is Fed increases the interest rate, it slows down the economic activity globally. So there's less demand for oil and gas, I suppose. And eventually this is going to be negatively affect the oil and gas exporting economies, given the price adjustments. So as you diversify more from oil and gas, you're going to be less affected. This is kind of the story that I could come up with. So, but for economic diversification, you are using the contribution of the manufacturing value added to the economy, which is also highly petrol or gas dependent in this part of the world. So because we're talking about petrochemicals basically, which is also highly bonded to economic activity anyway. So would you basically consider or give us a more appealing story using other alternative diversification measures where you capture things like, you know, IT sector or tourism, things like that? And one more question, quick question to Fatih. I think I saw UAE indicating a negative discount rate. Could you please tell us what that ever means? And the follow-up question, you know, technologies like CCUS and clean hydrogen, if not blue, are there to our transition ambitions in this part of the world. So how do you think those projects will fit into your model? Thanks.
Okay. Maybe let's take more questions and give you times, please.
Thank you. I'm Klaus Schmidt-Hebel from Chile, and I have a very complimentary question on your excellent paper. Congrats for the publication in Energy Economics, your second one, I understand. So great. Very related to the previous question, which is the very wide, astonishingly wide range in your estimates of discount rates. Qatar plus 17%, the highest, and the lowest is UAE minus 4% net discount rate per year. What's the implication of that? It implies that if you have an investment project which will mature at the year 2050, net zero, you discount it at a discount rate, gross discount rate of 27. In other words, you give zero weight to anything produced into the future or anything produced for the future in Qatar, in the Qatar economy. Nobody should worry about the future beyond 2 or 3 years or so, whatever. In the UAE, it's the opposite. It's a net discount rate of minus 4%, which you, if you accumulate it per year, it's very easy to do this, obviously, geometrical composition, you get a net discount rate, gross discount rate, net, whatever, of 0.10. You value 10 times as much what you have in 2050 than what you have now. So you should not consume today, zero, zip. You should save everything for this wonderful future of your kids and grandchildren in 2050. Does it make sense?
Thank you. Right. No, does this?
That's okay. To Bedri, Kuwait is currency is related to basket of currencies versus the other 5 GCCs, which are pegged to the dollar. So did you do any comparison between these 5 countries, the impact of the U.S. fiscal policies in Kuwait versus the other 5 GCC countries because of the exchange policies? The other thing is, isn't it obvious that because the oil is traded in dollars, then there will be an impact of U.S. policy, U.S. fiscal monetary policy on the our countries? And did you think of the idea of BRICS trying to come up with an alternative currency to trade oil? What would be the impact of that? Thank you.
Thank you so much for the very interesting presentation and congratulations on your publication. I believe that the issue of discount rate has been raised by several other colleagues, but my understanding that is you already estimated the discount rate from a macroeconomic data, which allow you to capture the macroeconomic risk, or at the best, you will be capturing the systematic risk for the country. And when you use this to evaluate and discount future cash flows for the projects, your discounted value wouldn't be as accurate as possible, because simply you are ignoring the specific risk projects. And this actually much more important to capture the cooperation and specific risk for each projects to be able to accurately estimate the discount rate. And I believe that is what our colleague here mentioned, that is normally when you are evaluating the discount risk factors for the project, normally we could use the weighted average cost of capital for the projects as a proxy, or as an alternative, you could use the discount rate for the oil industry, for example, which will be much more relevant. And we never know whether you will be able to alter or the results will be changed in this case. So thank you so much, and thank you.
Okay, so thanks a lot for the excellent comments. Your comments reminded me the comments of my PhD advisor. He was mentioning that my analysis is econometrics of the obvious. So that's obvious, but we are still conducting some econometrics analysis with respect to that. But you are right. So there are a lot of determinants of these effects. With respect to Kuwait, there are some data limitations, so we didn't have that in our data set. And also our data set contains 40 countries. So considering data availability, so it is not only GCC countries, but as you have mentioned, as a future research, what we are planning to do is, this is also related to your question. So why do some countries are more sensitive compared to others? So there must be other factors. So we are also planning to do a panel data analysis related to that. So for now, what we have is, we do not consider the exchange rate policy, but what we will do is we will add that as an additional section. And that's an excellent point with respect to policy. So maybe this also has some implications related to alternative currency. So I will definitely look into, and that's an excellent comment. So with respect to policy implications, I'll add that. So very constructive comments. So thanks a lot. And also with respect to how we measure economic diversification, I have presented the results with the ratio of manufacturing. So because most of the World Bank reports do that, but we also have manufacturing plus services. But I agree. So we haven't differentiated with respect to manufacturing, but manufacturing can be also related to petrochemicals. So we haven't identified, but it is also related to, with respect to data availability. But again, it boils down to the details and what causes these different effects. So maybe I'll try to find more data about that and try to have petrochemical sector. So thanks a lot.
All right. Okay. Thank you very much for those questions. So I will answer first the question about the CCUS and clean hydrogen. To respond to your question, we need to understand to what extent you are touching the domestic oil demand. If your project, CCUS or clean hydrogen, is displacing some oil from domestic oil consumption, in that case, you need to use the risk-adjusted discount rate that we are proposing. But if it is not touching the domestic oil demand, then you need to go for the risk-free discount rate, because it is not related to the future cash flows coming from exporting an additional barrel of oil. So the UAE case, which is a negative discount rate. So as my colleague was mentioning, of course, it is quite shocking when you see this, and this is actually coming from an important precautionary effect, which is coming from the 2009 and 2010 financial and real estate crisis in the UAE. And since we have this in our data, it had a huge impact into the volatility, and this put the discount rate into a negative value. When we excluded, we have this in the paper, we excluded those 2 years from our data, and then we came up with a positive discount rate for the UAE.
That makes sense.
Yeah, and for Qatar, again, we had a discussion with Dr. Majid about Qatar. So for Qatar, they have a very significantly high average growth rate for per capita consumption.
Mhm.
They have a huge wealth effect. So for them, the future is already bright, right? There is they don't need to invest, they don't need to save, because future is already bright according to the data we have. But probably if we have larger data sets, having, I mean,
Longer series.
exactly, at that time probably we will come up with have a lower discount rate for Qatar as well. And the final thing about the discount rates that can differ if you look at different industries. True, but please note that we are concerned with the social discount rate from the perspective of a public policy maker. In a given sector or in a given industry, they care about the profits. They don't care about what is the social value of investing in a project. So that's why in our case, we are using macroeconomic data rather than project-specific data. And for oil-dependent countries, we are considering one simple specific project which is touching the oil consumption. In that case, we are showing that the real risk-adjusted discount rate should be used to value cash flows coming from that kind of project. But again, yes, in different sectors, different industries, you might need some more specific discount rates, maybe rather than this social discount rate.
Thank you.
Thank you.
Thanks, Fatih. I think it's time for lunch. Please join me to thank the panelists for their excellent presentations.
معلش نحن الحقيقة في انتظار التو discussants دكتور ماجد المنيف ودكتور كلاوس. Hopefully once they come we'll دي مش ده مش الروم نمبر 1 ده عندنا. لا احنا مش إذا معناها نحن المفروض نكون في روم تانية. لا يعني لسه في البارالل يعني.
بس يا دكتور احنا لسه هنا في سبيشال بانل بي، دي اللي حضرتك بتتكلم عليها بتاعت كلاس ماشي، دي لسه الساعة 4.
بعد دي ايوه، يعني ما كلهم بارالل يعني. اوكي. انا اذا ضللت دكتور ماجد ساكت، قلت له يعني لازم امشي اشرح له الفكره.
بسم الله الرحمن الرحيم. welcome to special panel B, the potential of energy efficiency in GCC countries. My name is Amal Abedli. I'm the chair and moderator for this session. We're very fortunate to have three very experienced and accomplished scholars and practitioners mix for the session today. We have Marcello Contastabile. It's difficult. It is difficult for me. And he is from Italian origin, but he's working with the Qatar Environmental Research Energy Institute. We have Qais Al-Suwaidi. TAQA is the TAQA, okay, TAQA, which is the Energy Efficiency Authority in UAE, or okay, probably the National Energy Company. And on my left, Turki, who's with the Saudi Energy Efficiency Center, also known as KAFA'a, or
yes, exactly.
KAFA'a. Today the session will be non-academic in its format. We're going to have a panel discussion for around half an hour, 35 minutes to start the session, and then I'll open the floor for interventions and questions. So it's going to be light. I'd like to start with Turki on my left, from KAFA'a. So now the session is on energy efficiency, but before we get into the details of energy efficiency, I want to ask a broader question. We were talking before lunch about the size of your organization. Just for those not familiar like me, KAFA'a is an independent regularity entity tasked or mandated to oversee the energy efficiency codes in the Kingdom of Saudi Arabia. So could you describe to me what the relationship between the research community is and KAFA'a? If I was a researcher in Saudi and I did some research on energy efficiency, how would that research enter into your organization's workflow?
Thank you very much, Mr. Dr. Ammar, for this great introduction, and it's my pleasure to be here, part of this informative session. It's an excellent question talking about the R&D role within our organization. Let me start briefly explaining and defining our organization. I am representing SEEC, which stands for Saudi Energy Efficiency Center. We are a governmental entity established in 2010 through the Council of Ministers, with a clear aim of setting the policies and the regulations with one clear objective, which is preserving our natural resources and helping to elevate the energy efficiency in the kingdom. Our role mainly is to coordinate with the stakeholders. We are working with more than 30 governmental and semi-governmental entities. They are representing a union of efforts that led to have the Saudi Energy Efficiency Program. This is the broader picture of our field. We are working under the Saudi Energy Efficiency Program to set the standards and the regulations on main sectors, which is building, transportation, and industry. Back to Dr. Ammar's question regarding the R&D and the research, we have recently established also the human capital stream, where we are trying to empower the R&D, where we are engaging with more than 21 universities in Saudi Arabia. We have now introduced energy efficiency elective courses in most of the universities. We try to invest in the young generation to aware them about the energy efficiency in all the dimensions and aspects. Moreover, we are trying to promote for the energy efficiency in terms of the master and the PhD, but still these kind of let's say efforts is in the beginning, to be transparently speaking. We have focused during our last 10 years to set the public policies for the public and for the private sectors. Now our second phase will focus more on the enablement, on the incentives, and most importantly on the R&D. We are still in the early stages, but we have active now channels, especially with the leading companies such as Aramco, Sabiq Ma'ali, because they have their own
advanced R&D centers. And also we have our active channels with the local universities where we are trying to promote more intensive streams for the energy efficiency. I hope I answer your question, Dr. Umar.
Thank you. So I want to move to Mr. Qais on the issue of UAE and Abu Dhabi. Now, I mean, Abu Dhabi is a country, an emirate with a strong reputation in this issue. We have Masdar, which was, I think it's been over 10 years since Masdar was established. It's now been, I think, integrated into Khalifa University. There's a variety of programs relating indirectly to energy efficiency in UAE, and now obviously have COP28 coming up in a few weeks. But I'm interested in the UAE's your perspective from talking about the UAE on this issue. When Khalifa University or Masdar, or which produce a lot of sometimes very technical, sometimes more policy-oriented research, how do you absorb that into your company? How does it affect your operations?
Assalamu alaikum. Good afternoon, everyone. I have to say, at the outset, thank, of course, the ERF and KAPSARC for the invitation, for having me and having us today in this panel. So let me, Dr. Umar, maybe start with an introduction as to what TAQA is, because I'm having kind of a hard time explaining what TAQA is to everyone. It's a company, so I'm more of a practitioner, less of an academic. TAQA stands for, it doesn't stand for anything. TAQA means energy in Arabic, basically, but TAQA is the Abu Dhabi National Energy Company. It's a listed company in the Abu Dhabi Exchange. It's the second biggest listed company in the UAE. It's one of the biggest biggest utility companies by market cap in the world. It's around number 2 or 3, looking at market cap. So TAQA.
Just to clarify, in the UAE is power generation, but at the Emirate, does each Emirate have its own company, or is there a federal company? Give us a quick overview so we understand.
Yeah, I'll explain that as well. So TAQA is more of an integrated utility company. We work across the value chain of power and water generation, transmission, distribution, and then we also have a small, in relative terms, oil and gas business. We operate mainly in Abu Dhabi and other emirates in the UAE, but also we have operations in 11 other countries. We also produce electricity in Morocco. 40% of Morocco's electricity is produced by TAQA, and we have operations in Ghana, India, and other countries around the world. Going back to your question, Dr. Umar, as to how the power and water sector works in the UAE. So there are 3 key utilities or utility companies in the UAE. One is TAQA. In Abu Dhabi, we have 3 different entities. One a regulator, another a system planner, an operator, and a third, which is TAQA, that owns assets, but then we also work with other companies through independent power producers and so on. So it's quite complicated, the scene in Abu Dhabi, but in Dubai, it's mainly one player, which is DEWA, the Dubai Electricity and Water Authority. They're also an integrated utility, a vertically integrated utility. But we also have FIWA, a smaller federal utility, and we have SEGWA, I think it's called now, in Sharjah. That's also a utility company, but they also have gas under their mandate. And all of that, of course, is regulated through the federal regulator, which is the Ministry of Energy and Infrastructure across the UAE. So back to your question as to how TAQA works with the academic sector. Of course, TAQA is a group of companies. We have transmission, distribution companies, and we have generation companies. So these companies do work with the academic sector, but mainly on the technology side of things, more on the applied sciences side of things. So when it comes to optimization of operations in generating electricity, in desalinating water, and similarly in a more efficient transmission distribution of power and water. This is where the interface with the academic sector is mainly focused. But having said that, we also energy efficiency is also, since this is of course the topic of this session, energy efficiency is also in the mandate of TAQA through its subsidiary Abu Dhabi Energy Company. So it's a super ESCO that was created by TAQA and that was mandated by the Abu Dhabi government for retrofitting, but also to make the market as a market maker of energy efficiency in Abu Dhabi and the broader UAE.
Thank you. Marcelo, so you work in Qatar and the GCC countries. So building on this question of how research plays into energy efficiency policy decisions, if you ask any economist, how do you improve energy efficiency, especially from the end user side, the first recommendation they say is increase the price. And the GCC countries have historically had very low cost, low tariffs. Recently, I'd say after 2014 especially, but in the last 15 years, they've been generally scaling back subsidies, although ironically in the case of Qatar, I think for citizens in their first home it's still free, but certainly for additional homes and then for expatriates, they have to pay much more than they used to have to pay. Now, if you look at tables of electricity consumption per capita, it's not a good advertisement for the GCC. We have some of the highest income consumption per capita levels in the world, and it's not just because we use air conditioners. So why do you think it is the case that even though we've started to increase our prices to levels we see in other countries, not completely, but certainly much more than before, we've not really seen a big improvement in energy efficiency, at least from the consumer side. Maybe at the industrial side where some of the tariffs have been higher, but at the consumer side, we still see what looks like very wasteful consumption.
Okay, thank you very much for the interesting question. This is not one that I can address in full now. I think I will start, and then this will continue and hopefully involve our audience as well. In fact, it doesn't feel like an audience at all because we're all sitting around the same table. So I hope we'll have a very interesting conversation. So let me just say, first of all, good afternoon, everyone, and thanks for inviting me here. Very happy to be part of this panel. And coming to your question, of course, I mean, you asked previous panelists to talk about their countries, their organizations. I'll be happy to also talk about the structure of, say the power water sector in Qatar, how it's different, and the policy side of things. But coming to your question in particular, I would say that as you correctly said, subsidies are being or have been removed in some cases. But to remove subsidies is not necessarily enough to get to a point where there is a strong enough power signal to shift consumption behavior and adoption behavior of energy efficient technologies. I mean, if you look at the case of energy importing countries, I'm thinking Europe because I'm from Europe, Italy, but any other country in Europe is not very different. So obviously, imported fossil fuels are not subsidized, but they're also actually taxed. They're taxed quite heavily in one way or another. And why are we taxing them? I mean, an economist can go to the bottom of it, if you like, but really at a higher level, you can say, number one, there are major rents associated with fossil fuels. And by taxing, you as a government are capturing part of the rent. Secondly, imported fossil fuels create energy security issues, not only in terms of securing the supply, but also, and most importantly, in terms of price volatility issues. So the more you consume, the more you are exposed financially as a country to price volatility, the more it will cost you as a country, and the more it will impact your GDP if fossil fuel prices go up. So energy efficiency has a big role to play, although this is something that I don't think is discussed very much, but energy efficiency has an important role to play when it comes to mitigating risk from price volatility for importing countries. Obviously, this argument does not apply to energy exporting countries. So what you want to do is definitely not have to lose money by using your fuels domestically when you could be exporting them. And this is why, this is the rationale for removing the subsidies. But then, you know, if you want to make fuels expensive to the point where especially consumers have an incentive to adopt more energy efficient technologies, just look at the price of, say, transport fuels or electricity in GCC countries and compare them with the price of transport fuels and electricity in Europe. They really are quite different. So you can see there is still a big gap there. And how do you address that? Is it going to be through taxation or other means? And I would argue that taxation is not necessarily the most straightforward way of doing it from a, so if you like, a political perspective. So then you're left with standards and you're left with other measures that can support adoption of if you like, supply side measures rather than demand side measures, or possibly both, that can support the adoption of more efficient technologies. So I will leave it at that.
Thank you. Talal, did you want to add? Yes. Did you want to add? Or?
Yeah. Yeah, so I just wanted to say something. So, of course, you know, most of the GCC countries are, well, most of them are energy exporting. It depends whether it's oil or gas, right? And then if you take a country like the UAE, of course, the UAE is not one, right? You have Abu Dhabi, you have Dubai, you have the other Emirates. And then when it comes to natural gas, for example, it is important. It's a good chunk of natural gas in the UAE. That's, you know, we heavily rely on natural gas for power production and water desalination. It is, you know, the gas is important. Hence, you know, the sort of the march towards alternatives, and hence, you know, Masdar and maybe nuclear. It all goes back to the, maybe you look at the year 2008. It is the year where this whole discussion around nuclear started and Masdar started, but then it is also the year when the UAE started to becoming a net importer of natural gas. So it is a question of energy security as well. So the way we look at it as a company as well, and in our discussions with the regulators, with the policymakers, is that energy efficiency is about energy security. It's about, of course, affordability, but it's also about reducing the subsidies. Right, so it's all of the above kind of. So I don't think GCC countries, similarly with the drive in Saudi Arabia, right? So there is the incentive is there. The government does have the incentive, but if you look at Abu Dhabi and Dubai, for example, there is no subsidy for power or water, whether you're an Emirati citizen or not. You get that lower price for your power and water if you're an Emirati citizen in Dubai, for example, but not. But in Abu Dhabi, everyone gets a lower price, which is subsidized, which is not cost reflective. So you want to reduce those subsidies, and hence, you know, this drive towards energy efficiency. And perhaps one more point to add there, it is about reducing subsidies, but it's also about economic opportunities that come with that. So it is more about the technologies that come with that. It is about also the digitalization, right? Moving towards digital, especially when it comes to the grid. And energy efficient technologies, of course, in the production of power and water. So again, I just think, you know, GCC countries are not different from the rest of the world, but then we might have our own challenges when it comes to demand, to signaling to the market, you know, in terms of you know, energy efficiency, you know, reduce demand and so on. So we have our own challenges. Maybe governments are not willing. There are certain, you know, hurdles to governments maybe going ahead and, you know, getting rid of subsidies in certain parts of the GCC, but others have done it. Has that, you know, impacted demand? That's a question that we should maybe look into. So if I look at Dubai, for example, I don't think that, you know, emissions per capita or power consumption per capita is very different in Dubai compared to the other Emirates. So yeah, so this again begs the question of whether, you know, that's the only answer. Is it only the incentives? Is just the price signals that are going to, you know, do the trick, or is it more than that?
So let's move on to Turkey on an issue on the other side of it, or one side of it, which is the cultural side. Now, you're an engineer, and, you know, probably, you know, a lot of these organizations, when they think about energy efficiency, they think about technical solutions for energy efficiency. But the reality is there's human behavior side to it too. Now, I grew up in the UK. In the UK, it was totally normal when I was growing up for somebody to, if somebody comes up with a way of on how to save money or how to save power or something, it's almost you have high social status to show off. Oh, I worked out how to save petrol when I drive my car. I worked out. Whereas in the Gulf, the culture is not like that. It's not. People don't show off about saving money. People don't show off about economizing. On the contrary, people like to show off in our region about how big the meal we had on this wedding, or the culture is very different. So when you're trying to improve energy efficiency in Saudi, and you're not just looking at the technical side, you're looking at the human behavior side. Our culture is not very much a culture of economizing. It's very much a consumption culture. What challenges do you face in convincing normal Saudis to think more economically about how they consume energy?
Thank you very much, Dr. Umar, for this great question. طبعا, you touched on a very important element, which is the behavior and the awareness of the people. When we have started our journey in 2010, we were focusing mainly on setting the policies and the regulation. And as I mentioned earlier, we are targeting mainly 3 sectors: industry, building, and transportation. When it comes to the awareness, we are talking about mainly the building and the transportation. And it's somehow difficult to go with those harsh solutions, for example, taking the subsidy or having, let's say, increasing the prices, these kind of things. That's why we started from 2016 onward to launch a huge campaigns about the energy efficiency, why we need the energy efficiency in our daily life. And we are talking about